All right, so EMS trade setups, momentum funnel, and surge point. So now that you have a foundation in understanding price action, it's time to talk about the specific setups we use in EMS. So we're going to break down two core concepts here. The momentum funnel, also known as the funnel of doom or a wedge, and the surge point, which is the breakout point. So these two setups will give you clear entry points for every single one of your trades. You will never have to second guess where to enter, where to exit. Am I entering in the right spot? Am I doing this right? It's a clear set of rules that you'll follow that will work for every single wedge that presents itself. Okay. So the momentum funnel is what we call a wedge, a flag pattern, and EMS. So you might also hear it as the funnel of doom. I always, depends on the structure of it. Funnel of doom, momentum funnel, it's all really the same thing. So it's really when price action tightens within a range, right? Also higher lows and lower highs. So it's like the market coils and it builds that pressure like a pipe is about to burst, except the chart is about to burst, right? And you might ask, well, is that to the upside, the downside? We'll go over that in a second here. But it always leads to a big move. So there's a few signs that a momentum funnel is forming. First things first is the price action is going to tighten, right? Higher lows and lower highs. It's going to bounce back and forth between support and resistance. Second, you're going to see volume decline as the market waits for the breakout. And third, the price will hover near a key resistance or support level, getting ready to make that big move. Okay, let's actually go over an example before we continue here. So, perfect example is DJT here. Right, we have the lower highs, higher lows. Draw it out again. Let me delete the chart and redo it again so you guys can see. Right, so we have lower highs. Oops. Lower highs. We have like these higher lows here. And it's building this pressure underneath this resistance and over this previous resistance here, right? So we have that previous resistance, we pushed down, we acted as support. So now we know buyers are in this area. If we did drop down, I would expect it to bounce here. And now we have this resistance up above. And then, right, higher lows, lower highs. And it creates that coil. Now, let me replay the chart here, right? So it looks like this. So the price consolidates. And what we're looking for is, right, also declining volume, as I said before. So now we have the first step, which is price action getting tighter and tighter. Second step is the volume declining. And the third step is, right, it's hovering just under this resistance. So we have a high tight flag. What you don't want to be trading is an extended flag. And what do I mean by that? So an extended flag looks like this, where it just goes far, far out. These really, they work here and there, but it's not as profitable and consistent, right? So you might ask, well, what do we need to see then? Right? We want to see high and tight flags. High meaning high on the flagpole, and tight meaning like this, right? It's high on the flagpole and it's tight to the flagpole, right? Just like this, just like this. Not really like this, right? Although it worked out here, it doesn't tend to work out too often. Or it works out, but it's not as probable and it's not as an explosive move. So high tight flag. Okay. Let's get back to the PowerPoint here. So the surge point or the breakout point. This is where the magic happens. It's the moment when price finally breaks through the momentum funnel. And that is where we want to jump into the trade every single time. And timing is key because you want to enter as soon as it starts to break out, right? Could you enter a little bit before? Sure. You know, it depends what time of day it is. It depends the trend. It depends how the market's been moving. Do we have news coming up? Right? Is FOMC coming up? Is there earnings? How is implied volatility working so far? Right? And you should know all those terms based on the book. And remember, we're only trading 9:30 to 10:30 and 2:45 to 4. Right? We're not trading in the middle of the day because, right, you should also know that from the book. But those time frames that we're trading gives us the highest chance of breakouts to happen, because that's where a majority of the market players are playing and trading. So the surge point, right? Let's go over a few examples of the surge point. So the surge point on this example, we'd want to take an entry as soon as it starts to break out through that resistance. I could change the color here, right? Through that resistance. And we want to see the volume here increase. Now, increasing, right? You might ask, well, how do I know if it's increasing just over the most recent candle, right? We want to just see this to start pushing through or over this previous candle. Okay. So this is where we enter in this example. Let's go over another example. Let me take out the replay here. And as you can see, breakout happened, volume increased, and this totally worked out. It pushed right into the resistance. And you might ask, well, you know, now it's in hindsight. Well, I did take this trade in real time. There's actually a replay of it in the resources section if you want to go take a look at it. But this trade ended up hitting like 300%, I believe. I alerted it real time on Zoom, and it was a textbook setup. And then it ended up pushing up again, and I traded it again here, right? So we have the lower high, higher low, and the entry point as soon as it started to break through, right? Notice we have declining volume. We start to increase the volume, and we entered as soon as it started to break out, looking for a move to this high. Now, just in this little move, I'm pretty sure we secured 10-15%. It's not going to be as of an explosive move because we already had this huge move here. So it's not going to be explosive every single time, right? Where are we in the trend? Have we consolidated for a long period of time? Right. Notice how this wedge is much bigger than this wedge. So the bigger the wedge, typically the bigger the breakout, right? If we have a small little wedge here, it's going to be a smaller little breakout. Okay. It's another thing. Right. So the bigger the wedge, or, you know, the higher time frame you're on, and if it's big on a high time frame, it's going to be solid, right? This is the 1 hour time frame. Notice how this wedge is much bigger than this one. So this is probably going to be smaller. I'm going to size smaller on this one than I am on this one. Okay, right? I always size with about 1 to 2% on my main account. This one I would do 1%. This one I would do 2%. Okay. Let's go over another surge point example here. Apple, right? So for example, we could do this trade we took here. Okay, we have resistance, 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 resistance. We also have these higher lows here. Right, it's consolidating. We also should probably draw out the previous supports here. Right, so notice support, 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 support. I'm assuming this was a previous resistance somewhere at one point. Right, this also was a previous support here, right? So if we scroll back, support, 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 access support again, it turns into a resistance, right? So multiple times this level bounced. And now, right, we're putting in those higher lows, lower highs. The entry point here is as soon as it starts to break out here, right? And the stop loss is always below the most recent low. But you enter here, and notice volume was declining as we're consolidating, and it starts to increase right there as soon as it starts to break out. And it totally pushes through this resistance up above and totally hits the price target there and hits the price target there. And then it even goes up a little bit further into this zone there. This trade, I think, ended up hitting 200% or so. right? So notice we had a ton of consolidation here, right? We were just sideways here for this whole period, right? So the larger the consolidation, typically the bigger the breakout. Okay? Now again, it's doing the same thing here, just on a smaller scale, right? Higher lows, lower highs. We can look to take a breakout. Even I'm going to look at this tomorrow for a trade over this resistance for a push into this gap here. Oh, that's not all right. Let me use a box here. Right into this zone. All right, so now I'm going to look for an entry here. The stop loss right below for a push through this resistance into this level here, 231 or so. Right, gaps tend to get filled. Okay. Back to the PowerPoint. So that's the surge point. So when trading the setup, so I think I just covered this, right? A strong move out of the funnel, right? It tells you the breakout's real. Volume typically spikes, like I just mentioned, confirming that the momentum is actually behind the move. And then as soon as you see this, right, it's time to enter the trade. The earlier, the better. One thing I also want to mention is a lot of people ask, do I use limit orders? Do I use market orders? I go over this in the book, so you should know this already, but I'll mention it again. It depends what name I'm trading, how wide the spread is on the bid and the ask. If it's a tight spread, I will, and I want to get in the trade quickly, I'll just either do limit at ask, or if I really want to get in at 0 DT, it's, is moving quickly, I'll just do a market order. But if the spread's wide, meaning it's a 100 to 180 bid ask, I'm absolutely not doing a market order. Otherwise, you'll be down $80 immediately. Right, I'm going to send in a limit order at the midpoint typically and see if I get filled. If not, I'll end up just skipping it and I'll wait for the next trade. Right? You do not want to get screwed by getting filled at asking price on a wide spread. You will be down immediately and you will not be happy. So this is why I like to trade the same names over and over and over again. I know how the spreads work. I know, do I want to get filled at a limit ask, limit mid, or just market order, right? SPX or SPY 0 DTE, I could just do market orders. The spreads are extremely tight. I'd rather pay a little bit in premium and to catch the move that I'm looking for than to miss it and have a canceling order that I need to place through. So that's that. Let's keep it going here. So once you're in a trade, your next goal is to manage the trade properly, right? You need to set your stop loss just below the funnel to minimize your risk. And I have aimed for a 2-to-1 risk to reward here. Don't even worry about it, right? The setups that we're trading have good risk to rewards. Don't need you don't need to measure it. You don't need to think about it too often. It's never a thought in my head, to be honest. I'm looking for A+ setups that I can have a high win rate, and they typically have explosive moves, so it typically profits 50% plus, to be honest. And then sometimes we can get more than 2-to-1. Sometimes it's 3-to-1, 4-to-1, depending on market momentum, and is SPY and QQQ pushing up? Is tech strong? Is the other names weak? Are small cap strong? The other names weak? Vice versa, right? When everything's in your favor, that's when the moves really happen, right? I always mention in the Discord, the only difference between a 15% trade and a 1000% trade is just market momentum, right? We're trading the same exact setups, but one name doesn't break out fully, but we scale out on the way up, and the other one actually fully breaks out and explodes and just continues to rise to the upside. So, and then you want to exit the trade when momentum slows down, or the price is getting close to a resistance level. So let's pull up the charts again here and go over how we go about exiting. So like we mentioned here, you got to set your resistance points before you get into the trade. All right, we have one resistance there, one resistance here, Another resistance right there. I always like to set a minimum of 3 or 4 targets up above so I know where to look. Let's remove this so it's a little bit cleaner. So this is what the setup would look like at this point here, right? This is what it looks like. So we enter at the break of this wedge. We're going to have a stop loss either below this low. You could have one below this, but it's too far, right? I'd rather get out here because it does help our risk to reward. So I would have a stop loss right below there, an entry point here. Or you could even enter right above at this resistance too, right at this level. Either work. This one would be a little bit early, but if it does take a loss, it would be a little bit smaller than going at 225.97 here. And how do you go about scaling out or, taking profit and managing your risk, right? We start to push through. You want to start to scale out before the resistance levels, right? Into strength. When you start to sell into strength, and into strength means that it's a strong candle like this or like this, not like this, you get great fills and you typically get much higher percentages. Right? If you're selling into strength, that could be the difference between getting 50% on a trade or 35%. Right? As soon as it starts to pull back, those contracts are going to pull back also. And contracts are times 100. So you always want to sell into strength. And I always like to sell slightly before resistance. That way I could sell into that strength. So I would sell right in this zone around here. And I would sell some more into this zone here as we push up. And then also right around here. Okay. You don't want to wait till the resistance because then you're going to be stuck selling when it starts to sell off. Now, obviously, you're going to have those times when it's just going to push through and there's going to be no pullbacks. That's going to happen here and there. You're also going to have those times when you enter and it just pulls back right away and you take a stop. You take a loss. And remember, losses are normal. I lose all the time. Right? You're going to have times where you lose, the entire week. But you need to manage that risk and you need to follow the trades. Do not let it get to your head. Okay. Hopefully that'll make sense. Let's pull the PowerPoint back up. So, key takeaways. The momentum funnel is a sign that the market is building pressure for a bigger move. The surge point or the breakout point is where you enter the trade once price starts to break out. And you have to make sure you manage your risk always by setting, I do mental stop losses. And then I set those targeted key levels, right? You might ask, why don't you set hard stop losses, like actual stop losses, based on a percentage or based on a key level? I don't set hard stop losses because the market wicks, right? It's volatile. It goes up and down. Contracts move up and down. I'm sizing small enough where I can handle the volatility, and I don't want to get stopped out of a trade that just wicks down and shoots back up, right? How many times have you guys been in a trade where it wicks down? I'll pull the chart back up, right? Where it pulls back and then it launches to the upside, right? I like to give it a little bit of time there. That way that doesn't happen, right? You can always get back in, of course. But I just do mental stop losses and I watch my trade and I'll scale out manually if that does happen. So manual stop losses, but I set hard price targets up above. Or if it was a bearish setup, I would set the targets to the downside. Okay. Let's keep it going. So in the next video, we're going to dive more into risk management with EMS. I'll show you how to protect your account, how to maximize profits while keeping your risk in check. So let's dive into it.